Hi friends, this is Rahul Jain, and in today's video we are going to discuss number 1, why sector analysis is important, and number 2, what all should be covered under the sector analysis. So number 1, why is sector analysis important? If you want to invest in a particular stock, you need to understand what is happening in the sector in which the stock is operating. A sector may be in the phases of headwinds or tailwinds or somewhere in between. Headwinds are factors that may impede the growth of the sector, while tailwinds are factors that may support the growth of a sector. For example, currently the renewable energy sector is having tailwinds. Indian government's target of adding 500 gigawattage of electric power from renewable energy sources is a tailwind for the sector. This will indicate that the renewable energy sector is likely to see positive demand because of conducive government policy. Hence, an investor may want to analyze stocks within the renewable energy sector to take advantage of the expected growth in this sector. Early identification of sectoral tailwinds could make all the difference in investing in stocks. Second example you can see is that the Government of India approved an outlay of rupees 76,000 crores for development of semiconductors and display manufacturing ecosystem. So this makes semiconductor sector attractive for investors. Third example is when in July 2023, the Ministry of Finance decided to levy a 28% GST on online gaming businesses. It became apparent that in the short term, profitability of such businesses may go down, and hence it was seen as a headwind for the sector. So it becomes very important for investors to analyze sectoral headwinds and tailwinds to find right investing opportunities. Now coming to the second key point, which is what all should be covered under sector analysis. Whenever you want to analyze a stock vis-a-vis its sector, there are 4 broad themes you should analyze. Number 1, headwinds faced by sector. Number 2, tailwinds faced by sector. Number 3, sector agnostic parameters. And number 4, sector specific parameters. Number 1 and 2 I have already explained using examples, so let me give you examples of number 3 and number 4. Number 3, sector agnostic parameters. Whenever you want to evaluate and study a stock's performance versus its sector performance, there are few sector agnostic, meaning applies to almost all sectors, parameters that you should consider comparing. For example, 1. Last 3 years average revenue growth in the sector versus revenue growth of the stock under consideration. 2. Last 3 years average profit growth of the sector versus profit growth of the stock under consideration. 3. Stock's PE ratio versus average PE ratio of the sector. 4. Stock's PB ratio versus average PB ratio of the sector. These parameters will help you understand if the stock you are evaluating has been growing faster or slower than the sector, and therefore is the valuation of the stock justified vis-a-vis its growth performance. Now moving to 4th broad theme, sector specific parameters. Each sector has its own KPIs that investors must evaluate stocks on. For example, when you are evaluating the banking sector, KPIs such as NPA, non-performing assets, in simple terms called bad debt, becomes an important KPI for comparing banking sector stocks. Lower the NPA of a bank, better is the quality of its loan book. If most banks have NPAs at 2% level, and if the stock you are considering has 7% NPA, then this means that the stock you are considering for investment has shown inferior performance on this parameter. Another example could be NIM, net interest margin, which is a measure of the difference between the interest income generated by the banks from its borrowers and the amount of interest paid out to its lenders or depositors. Higher the NIM of a bank, the better is the bank's performance in this regard. If most banks' NIM are at 3%, and if the stock you are considering has NIM of 5%, this may impact your investment decision positively. If you look at the IT sector, one important KPI to consider is deals pipeline. This is the total confirmed deals or orders a company has at a specific point in time. Because future revenues of an IT company largely depends on their deal pipeline. Consider 2 IT companies. Both generated revenues in the range of $1 million in the last fiscal year, but company A has a 10 million US dollar deal pipeline versus company B that has a $3 million of deal pipeline. Company A has a higher visibility of future revenue, and this may have a positive impact in your investing decision. Understanding sector-specific KPIs comes with experience and by spending time analyzing the annual reports and earnings presentation of the companies. So in summary, we have understood why sector analysis is important for investing in stocks, as well as we have learned what are some of the considerations while doing sector analysis. I hope you found this video helpful. I look forward to see you in my next video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.